Zoom
We
says
are live.
preparing. Okay. I was thinking about it. And then,
So do you ever go back on to LinkedIn to see how it shows from your live?
yeah, I'm looking at it right now.
Oh, okay.
Let's let me try refreshing. Oh, there we go. It's showing up, even though I'm able to stream. Are you serious?
It's
It's
saying
showing.
that.
Uh, uh, okay, Restream says we're live. And it's live on LinkedIn. Let's check the YouTube. And I'm just going to assume that Facebook is working,
Mhm.
but I don't think anybody actually watches on Facebook, so I'm not too concerned about it. Yeah, it's working on YouTube.
Okay. Yeah.
All
Yeah,
right.
on LinkedIn too. It looks good. So everything looks good.
Yeah. All right. So we have about 2.5 minutes till the top of the hour, and we will get started. And for our repeat viewers, I actually redid the slides. So I found this service called Typeset, which is pretty cool. I like it a lot. Um, you can you can input just like text, and then it will auto arrange stuff into slides, and then you can take each slide and format it however you want, and it'll make suggestions, and it's a pretty cool tool.
That's cool.
Um, I do not have an affiliate link with them, but I should get one because I like it a lot.
Definitely.
And so this version of the presentation was made with that instead of my own, futzing around in Google Slides. So
So this is be some more new content here.
new content, absolutely. 0 calorie soda. All right, 1 minute. I don't know if Ram's going to join us or not, but he might.
Yep. He said he'll show up. So let's see.
Just 50 more seconds. And we'll be doing the first Tax Sherpa Live of 2024.
Starting the year off right.
All right. Oh, somebody's joining. Oh, there's Ram. They promote him to panelist. There he is. And we're going top of the hours in 5 seconds here. And welcome everybody. Today is January 16th, 2024. This is the first Tax Sherpa Live of the new year. I'm Neil, your host, I guess. And with me is Serena. She's our ops
Hello,
manager.
hello.
We got Ram on the call. He's one of our tax experts. And it says Randy on there, but we've got two Randys. So Randy M became Ram.
Right.
Yeah. First Randy is still just Randy, but Randy M is Ram. So that's how we handled having two Randys here, which I honestly never even occurred to me that that could even happen. Uh, but this is our office hours Q&A. So we alternate between just open question and answer sessions and then actual prepared content kind of stuff. So the way we do these is we just have questions that come in throughout the week from clients. From we got one from a YouTube comment from the last time, and also if anybody has any questions on the live, we'll try to hit those as well. And yeah, I'll just go through them. These are not prepared or rehearsed in any way. We're just doing stuff off the cuff, and people have all kinds of tax questions. So here's a place to get your tax answers, and you can ask about other stuff as well. But those are the stuff that I'm especially qualified to answer. But I'll take a stab at whatever you got. Do I know the work of Hugh Drexen? No, I have no idea what that is. So there's an unqualified answer.
Right.
But before we get into that, let's go into a little bit more about how this all works. So here's my question for you. You know, Tony Robbins says the quality of our questions determines the quality of our life. And I think that actually makes a lot of sense because we can only move forward with the things that we know to work with. And I've certainly made mistakes in the past by not asking the right questions. So, the purpose of this is to try to help people get into the right frames and understanding the right place to be. And from there, we can move forward. So a little bit about me, my story. So I realized early on the corporate world was not for me. I can actually pinpoint the moment that it happened. I went to college for engineering at Georgia Tech, and I was interning out in Texas with AMD during the spring of 2000. And this was when the first 1 gigahertz processor was released. It was a big deal. People had all kinds of parties and everything. The stock of the company shot up, and then at the end of the term, so around May or so, we had an award ceremony internal to the company, and they were handing out plaques saying, John here, he got 3 patents this year. Let's give him a hand. Everybody applauds. He goes up, gets his plaque. Of course, when you sign on to a tech company, there's an agreement that you make that all intellectual property that you devise belongs to the company. So that's just how it goes. But he got a plaque. Maybe he got a raise. I don't know. And there was a few of these. This took all morning. And then the last one that they handed out was to a guy. We'll call him Bob. And Bob got an award for the fact that during the launch, which was a big deal for the company, during the launch, he had a European vacation, a 2-week European vacation booked with his family, and had been done months ahead of time because we didn't know, exactly when the launch was going to be. We knew it was going to be sometime in the springtime, and it just happened so that his pre-approved vacation was during this time when we were going into this launch. I don't even know what department he worked for. I don't know if it was sales or tech or whatever, but he canceled his vacation so he could go into work for the company. And isn't he such a great company guy? Let's give him all a hand. And right then, I remember having this conversation in my head saying, this is not going to work for me. I don't want to have that kind of, imbalance in my personal and professional life. So from that point on, I started looking for other things rather than being an engineer like I thought it was going to be. And that started my whole entrepreneurial journey, which had ups and downs, lots of downs. And over the next several years, I did all kinds of stuff. I was trading stocks and options. I was a bartender. I actually ended up managing a bar. All kinds of other things. Did some real estate. And then in 2007, I started getting letters from the IRS, and they said, you owe us $1.3 million. And so I have been through that whole process where what happens is if you ignore those letters and the number's big enough, they'll start sending you certified mail where you have to sign for it with the postal carrier, or they'll hold it at the post office and you have to go in and sign for it. And if you ignore those, you start getting phone calls from revenue agents. And if you ignore those, they start garnishing whatever they can, bank accounts, paychecks, whatever. In my case, my bank account was essentially zero, and I did have a paycheck though, and they started garnishing that, and that really got my attention. So, and this whole process takes years to go through. So they started garnishing my paycheck, and I was like, okay, I have to fix this problem because there's no way I owe $1.3 million. I didn't make, $1.3 billion. So in fixing my own problem, I ended up hooking up with this former Wall Street tax attorney, and he helped me fix my issue, and I ended up paying none of that because I didn't know it. But in doing so, I saw into his business where his business was starting to grow, and he was great at taxes. He's totally terrible at actually running a business. I had the past 10 years behind me of doing my own thing, trying to start all these businesses. And uh, I brought all the things that I had learned because, each time you fail, you learn another thing. So what I did was I came into his business. I helped him scale with operations and systems and all these kind of things. And he taught me the tax world. And so I went into this whole Wall Street tax planning world. And over the next couple of years, we grew his business by we about tripled it, and I was done 50,000 tax returns on billions of dollars worth of revenue, and saving clients tens of millions of dollars a year. So that's how I came up in the tax world, and I didn't know until much later that that was not how most people learn taxes. So most people either take a course or maybe they get a degree in accounting or something along those lines, and then they just start doing taxes. So where I came in from the very business oriented side of things was very not usual. And the good thing about that is that, the focus that I've been in for the last, since 2011, so what is that, 13 years now, is that it's always about doing the thing in order to save the money and do it in a way that will be effective. And that's what I brought into Tax Sherpa. That's the whole mission of Tax Sherpa, is to help people, especially those small business owners, solopreneurs, independent contractors, who are getting absolutely nailed on taxes, and helping them structure things in the right way and in the optimal way so that they can, without having to earn any more or spend any less, they can save 10, 20, $50,000 in taxes. So that is kind of how we do things. But here's my question. So what is the root problem with overpaying on your taxes? And here's my take on that. The problem is that you're wasting your life, literally. So there's 365 days in a year. And if you're overpaying on taxes, that means you're spending that time working for the government instead of working for yourself. And, depending on your situation, maybe you can get that down to zero, maybe not. A lot of times we can come in and we can save, 20% on your tax bill, and, at 20% of the gross that we're talking about. So that translates to 74 days of a year, 74 days that you were working for the government that you're now working for yourself. And, whatever you want to do with those 74 days, it's totally up to you. Maybe you don't want to work at all during those 74 days and just want to keep the same take home. That's okay. Maybe you want to go on vacation. Maybe you want to reinvest that time into your business and grow it and scale things faster during that time. Whatever you decide to do with that is totally up to you and is the right decision as far as I'm concerned. But that is time that you can't get back. That's the one thing in life we can't get back, right? Is time. So wasting 20% of your life is just a killer, and it's a huge drag on the rest of your life because of that lost opportunity. So to me, that's what the root problem is with overpaying on your taxes. So you should do the things that you can in order to save that where possible. And also, I have the answer to all tax questions. Because everybody asks, what about this? What about that? Well, the answer is it depends. And it depends on what we call facts and circumstances. Almost every tax question depends on facts and circumstances, in that what is true in one person's circumstances is not true in another person's circumstances. And we'll get into, I know one of the questions we had from last time, we're going to get into some of those conditionalities as far as what makes it true in one situation and not true in another situation. But that is my intro. So let's go ahead and dive into some of the questions. Serena, what do we have up first?
So the first question a client asks is, if I build an ADU on my property and rent it out, how does that affect my taxes?
Yes. Okay. So this was the one I was talking about. We're going to get into the it depends quite a bit.
Hmm.
And for those who don't know, ADU is accessory dwelling unit. So a lot of jurisdictions have these. Like here in Atlanta, where I am, um, anybody can put an ADU in their backyard or maybe front yard, even. I don't know. But it's just kind of a carte blanche. Anybody can put one in. If you get two, then it's a permitting issue. But one is a freebie. So ADU is some kind of structure that's like an outbuilding. It could be a shed, it could be a tiny house, it could be a separate garage, it could be all kinds of things. But a lot of people have started taking these and turning them into short-term rentals. Doesn't have to be short-term, could be anything. Could be long-term, could be boat storage, could be whatever. But yeah, so effectively, if you're doing that, the ADU becomes a rental property. And immediately we go into the it depends.
Right.
So, how it affects your taxes. So, by default, real estate rentals are considered passive, which means they go on Schedule E1, E like Echo. And there is what's called the passive activity loss limitation. So, what happens is you have whatever revenue you have coming in for the rental, and you have whatever cash expenses that you have. So, maybe there's management fees, maybe there's advertising, maybe there's insurance or cleaning fees or whatever, um, mortgage interest, not mortgage principal, real estate taxes, all those kinds of things are deductible against that rental income. And then what tends to happen is that if you're good at rentals, that number left over will be positive because you're making positive cash flow month to month. If you're not so good at it, then that might be negative already. However, when you have depreciation, which is writing off a piece of the building itself over time, then there's this phantom expense called depreciation, and that almost always turns that number into a negative number after all expenses, including depreciation. And so what happens there is that you run into passive activity loss limitations. Because if it's a passive activity, the IRS or really Congress has decided in its infinite wisdom that you have limits on how much you can take as far as deductions against your other income. And the limit is $25,000. So if you have a W-2, let's say that's your only other income, W-2, you make 100 grand and you have this rental property, the most you can write off on that rental property in any 1 year is $25,000. So that'll take your income from 100 down to 75, and that will give you a tax break on your, well, that will lower your taxes on your overall situation. So that's great. If you make more than 100, between 100 and 150, that 25 starts to shrink. And once you reach 150, it goes to zero. And whatever losses that you have get suspended to the future. So if you're in excess of that 25,000 at any time, or if you get limited by your other income, the losses get pushed forward into the future until either your income's low enough to take the losses or until you sell the property. So that's level one of it depends. Uh, there are, however, ways around this, right? So way around this number one is if you're a real estate professional. So that if you're a real estate professional, that means that you are active in the real estate business. You spend at least 750 hours a year doing real estate activities, and at least 50% of your time is spent doing real estate stuff. And there's some definitions you can look up in the IRS code as far as like what activities qualify. So, like as an example, if you are a mortgage broker who works as a W-2 for a mortgage company, that does not count as real estate activities because you're not on your own. But if you're an independent agent and you're working for yourself getting 1099s, then that does count. So, more subtleties come into the mix. So if you're a real estate professional, you can avoid the passive activity loss limitations because you're considered active. Another way, and this is something I see on TikTok, YouTube. I don't actually look on TikTok, but I see it on Instagram. But that's kind of the thing to say now, I guess. I saw it on TikTok.
Yeah.
Where there's another set of regulations where if your average stay is under 7 days, then you are not considered to be a passive. It's not a passive rental. It's an active rental because essentially you're running a hotel. So this applies to all the Airbnb folk where, the average stay is, 3, 4, 5 days. You got to keep records and calculate this and make sure you qualify. Then it doesn't go on Schedule E, which is for passive rentals. It goes on Schedule C, which is active business. And now all of a sudden, active business, those passive activity loss limits don't apply. So that's another thing to consider. However, there is when it comes to the depreciation, there's a couple other things you got to keep in mind. So thing number one is that if you're doing this at your personal residence, then if you sell it later on, then you're going to have tax implications on the depreciation that you took. So normally in a personal residence, if you live there for 2 out of the most recent 5 years and you're single, you get a gain exclusion of 250,000. If you're married filing joint, you get a gain exclusion of 500,000. So most people, when they sell their primary residence, don't pay any tax because they're under those thresholds and they live there for at least 2 years. So if you take depreciation though, then you have to do depreciation recapture, and you do have to pay up to a 25% tax on that amount. So let's say you write off over the years, you write off $100,000 worth of depreciation for this ADU, and then you go to sell the property later on. You think normally, oh, it's my personal residence, I'm not going to own things. Like, well, hold on a second. If you depreciate it, then you got to pick that up. And if you took 100 grand, you got to recapture that 100 grand, and you're going to pay $25,000 worth of tax on that. So that's another factor to consider. Another factor on depreciation is cost segregation. So I've seen this strategy specifically on, I think I saw it on YouTube somewhere. A guy was saying, well, here's how I save my clients, whatever, however much money. And this can work where you have the ADU and you do a cost segregation analysis on it. And what that means is that, okay, so there's the structure. Normally real estate gets depreciated, for residential real estate gets depreciated over 27.5 years. So that's round about 4% a year of whatever the cost is. But cost segregation, what we do is we break up that structure into its component pieces. And some of those pieces are 5-year property. Some of those pieces are 7-year property. Some are 15-year property, and some are 27.5-year property. And the ones that are shorter term, because of the Trump tax reform back in 2017, Tax Cut and Jobs Act, we can capture all those depreciations in the first year. So it could be, and we've seen this happen, where you have a rental property. Let's say it's $500,000 all in, and 100,000 is land, 400,000 is building. Of the 400, 80 grand of it will be, the shorter term property. And so you get an $80,000 deduction in that first year. And so that could be a huge tax swing. And that if you combine that with either the fact that you're a real estate professional or it's a short-term rental, then that becomes active income and becomes a huge negative sign on your tax return. So that part is true. What they leave out on the YouTube channels and all the other promotional kind of stuff is that, if you have a W-2 income of 100,000, let's say, and you have a loss on either a Schedule C or a Schedule E active of $50,000, $80,000, that just becomes a huge audit target. And the reason it becomes a huge audit target is because it's a reasonable question. It's like, okay, well, if you made 100, you didn't take home 100 because there's income tax withholding, there's Social Security tax, there's Medicare tax, there's whatever withholdings you have for your health insurance and whatever. So, of the 100, maybe you took home 80. And if you have this $80,000 loss on the tax return, or 50,000 or whatever it is, that brings you down to, 30 or 20 or $10,000. And so the question becomes, okay, so you're making 100, you lost everything. What did you live on? And that's the rationale under which the IRS starts to take a closer look. So it's not that it's wrong. It's that it's very aggressive and has a high audit risk. So that's another factor yet to consider as far as, how do you want to treat these different things? Because these are all choices, right? As far as, how you treat these things for tax purposes and which schedules you want to use. Do you want to do cost segregation? Do you not want to do cost segregation? If it's a personal residence ADU, maybe you don't want to depreciate at all because you're planning on selling next year and you don't want to pick up the recapture. So, all these things go into the fact that it depends on the facts and circumstances. But these are the types of considerations that go into it. And so, you know, it depends,
It
basically.
depends.
But, in general, real estate, whatever form it takes, if you're doing rental real estate, the income that you get on a cash basis becomes at least tax protected in the sense that you can almost always at least write it off down to zero. Whether you want to go negative on that and count it off against other income is a much more complicated question and depends on what you have going on with other things. So I'm a fan of real estate, rental real estate in general, and it definitely can be a very tax efficient way to make income. So there's that. If you're purely a real estate person, your tax rate's almost always going to be super low, and we've got a lot of real estate investor clients who can attest to that. It's very much tax protected because Congress incentivizes the development of rental property because they don't want people living on the street essentially. So so that is the answer to that one. It all depends, but there's some general guidelines to consider. But you got to look at your individual numbers and how that all is going to work for you. All right. What's up next, Serena?
So another question that I have for you, Neil, is the client asks, if I sell a property on December 30th, but don't get the money until January 4th, when do I report the sale?
Yeah, so this is a good one. This was well, I won't say his name. We'll call him Bob. Bob
Bob.
sent that in. They were looking at selling a property right at the end of the year. And so this gets into a concept that is called constructive receipt. So when did you receive the money? Because most people are cash basis taxpayers, meaning that they're going to file whatever cash received, cash paid during the calendar year. December 31st is the cutoff. So constructive receipt is an idea that says basically when the funds are released to you, that's when you book it. So bank delays are not to be factored in. So if you sell a property on December 29th and the lawyer or title agent or whoever is doing the transaction, if they release the money on that same day, then even if it hits your bank later over the course of the new year, then you still count it as receiving it when the money was released. So the fact that the bank took, however many days to process and it didn't hit your account until the beginning of the next year, that's immaterial. However, if the lawyer doesn't cut the check or release the funds or initiate the wire or whatever it is until January 1st or January 2nd, even though the transaction quote unquote closed on the 29th, then it counts for the following. So it all depends on the specifics of when that money was considered clear and released to you. So that is constructive receipt, and this applies to a couple of different types of businesses. So real estate is one. We sometimes see this in e-commerce businesses where there'll be a vendor that's paying on like a net 30, and yeah, I think Amazon does a net 30. I'd have to look at that off the top of my head, but they will release funds and then it kind of shows up 5 days later, 3 days later, whatever. So sometimes we run into that there. And if you have especially if you're doing e-commerce, if you have large Christmas sales, then that can be an important factor as far as the timing of when things get booked. And you want to go into that knowing that this amount is going to be booked for this year and this amount is going to be booked into next year, because they can have dramatic impacts on the overall tax situation. So that is constructive receipt.
Yep.
All right. What do we have what do we have up next?
I have another question from a client says, what is this beneficial interest reporting I keep hearing about?
Yes. So this is part of the Corporate Transparency Act, which got So originally it was proposed in 2019, I think, and then it got included in one of the defense spending bills of 21, I believe it was. I wrote an article about this and put it on our blog at Tax Sherpa. Recorded a video also, which is on my YouTube channel. But basically, what it is the Congress decided that everybody who owns a company in the United States has to report a a beneficial interest report or beneficial ownership interest. It's BOI. It's BOI. I'm blanking on the exact terminology right this second. But yeah, so what you have to do is for every company in the United States that's actively doing business, then you have to submit this report to FinCEN, which is the enforcement agency for all financial stuff now, which was, I think FinCEN was created in the wake of the '08 meltdown. Used to be FINRA, and I don't know, bureaucracies, they like to morph and change over time. But yeah, so you have to fill out a report, and basically it's a very straightforward report. And the thing that annoys me the most about this whole thing is that there's no information on this report that the government doesn't already have, but they want you to put it into one centralized location so it's easier for them. So what it is anybody who owns 25% or more of the company, either directly or indirectly. So if you own a company that owns another company and you own 50% of that ownership company and that owns 25%, then you still are considered a beneficial interest. So any 25% owners or people who have substantial control, like officers of a corporation, or people who have substantial benefit from the assets of the company, that all those people get included in this report. And all it is you report to FinCEN, which is on fincen.gov. You report the name of the company, its address, and then just its identifying information. And then for each owner or each beneficial interest, their name, their address, their driver's license or passport, and then you have to upload a copy of that driver's license or passport. And what happens is this is creating a centralized database for the feds, which they're going to, share with local law enforcement and things. And the stated purpose of all this is to combat money laundering and financial support for terrorism. So theoretically, there are all these companies out there that aren't reporting anything. They're just creating companies and then never reporting anything again to the government, which I guess is possible. I don't know. Nobody who's doing anything approaching following the law is doing these kinds of things. So it's sort of like you're creating the system to take all the people who are already following the rules to put the information that you already have in various different forms into one centralized location. And you're probably going to have security leaks and it's probably going to get everywhere anyways. So that's stupid. But yeah, so this is a new law. It went into effect January 1st of 2024. And for companies that were in existence prior to 2024, so December 31st, 2023 and prior, you have until the end of 2024 to get this first report in. And if you're a new company starting in 2024, you have 90 days from the start of your business to get this report in. And starting in 2025, companies from there have 30 days to get the report in for their initial report. So if the company has has its original ownership, distribution, and it stays that way, that's all you have to do. You got to submit the report one time. If there are changes, you have to report those changes within 30 days of when the change happens. So if you sell some shares, if you buy some shares, if somebody dies, whatever. If you have a minor that becomes, over 18 and is now a legal adult, then report that within 30 days. And it's the same report. You just do an updated filing instead of an initial filing. So this basically applies to any company that has filed a document with a Secretary of State in any of the states. So basically, if you have an LLC, a corporation, that's all going to apply. If you have a sole proprietorship that has no LLC, then that does not apply because you haven't filed anything with the Secretary of State of your home state. But generally, that's a bad idea for any number of other reasons. So hopefully, you have at least an LLC. And so that is kind of the short version of it. It's going to create a just one more thing people have to file. And as far as the information in it, so the if there's a filing with the Secretary of State, the organizers of that filing are already on file with that Secretary of State. So most states you can just go online and look at any particular company, and you'll see the name of the company, the address, and the officers or members, down towards the bottom. And so that information is already there. Everybody who has a driver's license or a passport, that's already in a government, database, either with the Motor Vehicle Association of that state or with the feds with the passports. So that information is already there. And then the owners of a company are listed on tax returns. So that's information's already there with the IRS. And large companies where they don't have this issue. So large companies are exempt. There's like 23 exemptions. A lot of banks are exempt. A lot of financial type institutions are exempt. Um, so and large companies are exempt. So this really only affects small companies. and so on a 1120S or a 1065 or a Schedule C LLC filing, a disregarded entity filing, all of those things are listed as far as like who's the owner of them, because that's just part of the tax return. So this is all duplicate information that we are just putting more work into because the government says so. And the penalties for not doing so are severe. So there's civil penalties if you miss your deadline, $500 a day, and then if you are found to be willfully not complying, then there's potential criminal charges of up to 2 years in jail and a $10,000 fine. So the stick, there's a carrot and the stick. There's no carrot in the situation. There's just stick, and it's a big stick. So that's the whole approach here that they're taking. So it's a giant pain that everybody has to deal with, and it's because they say so, basically. And I have very
Yep.
little confidence that your information will stay safe, but that's just my opinion.
Yeah.
So we've had many instances of the IRS losing laptops and things like that. So I don't see this being any different than that.
Oh, that's crazy.
Yeah, I was reading one article.
Well,
Well, I was reading one article about it. About this guy was a retired CPA, and he wrote this whole long article about how this is unconstitutional, violation of right to privacy and all that kind of stuff. And I agree with him, but this is like so far down the road of things of that nature that I don't think this is going to hold up in court. And I'm certainly not going to be the guinea pig for testing out this legal theory that we can't actually be held to doing this. So I am going to comply, and I encourage everybody listening to comply and just get the information in there. Again, it's stuff they already have. It's just creating a centralized system for themselves. And will it prevent money laundering and financing of terrorism? I think probably not, but we'll see.
all right. So let me ask you something, Neil. So I did get a question from a client asking about if the FinCEN and the FBAR were the same thing, because they were a little confused on those
Right.
two.
So the FBAR is the Foreign Bank Account Reporting. I think that's what the A stands for. So FBAR also gets reported to FinCEN. It's the same agency, but it's a different report. So FBAR is if you have foreign bank accounts or brokerages or things like that, and you either have ownership or similar to the beneficial interest, if you have control. So we had one client who she was not an owner, but she was a higher up in a company, and she had signature authority over a bank account in Germany, I think it was. And so she had to report on the FBAR that she had signature control over this account, and there was however much money in there. So same agency, different report, and FBAR. If you take the total value of all your foreign accounts and they go over $10,000 on any single day during the year, then you have to file an FBAR for that year. And then on those, what you report is you report the bank, the name of the bank, the address of the bank, the account number, and then the high balance during the year. And however many accounts there are, you list them all in the report, you submit it to FinCEN, and that's it. Um, so none of these are actually tax issues, but people come to us a lot with this kind of questioning because it has to do with their entities and stuff. And we talk a lot with our clients about entity structuring and how to take advantage of the tax code on their behalf.
So we have another question from Bob, and Bob wants to know, and it's kind of funny this question here, but he said, "Can my life insurance be considered a business expense since the business can't really survive without me?"
Yeah, so usually the answer is no. Life insurance tends to work on an after-tax basis, which is why the beneficiary of the policy when you do die does not have to pay any tax on it. So if you so that's the usual answer. If you want to go ahead and try to deduct that, then it becomes a taxable event when the policy cashes out, which maybe you don't care about, but maybe most people do. So it changes the character of the whole thing. So the simplest thing to do is to just treat it as sort of like a Roth kind of event, and that is post-tax money that goes in as premium. And then when you borrow money out, it's tax-free. When the policy matures, it's tax-free. And when the policy cashes out from death, then it's also tax-free. So yeah, I would not recommend. Listen, in every case I can think of, I would not recommend trying to take a deduction out of it because it just causes so many problems down the road.
So don't do it.
Yeah. And also there's a million different kinds of insurance, life insurance. There's whole life, there's universal life, there's indexed universal, there's term life insurance. And each one has its own subtleties of what's going on. But for those kind of questions, usually it's somebody who's doing either whole life or universal or index universal. And there's like a cash savings component of the insurance. Now, that's not to say that it can't be done. So there are arrangements that can be made. If you want to go down a deep dive in or a rabbit hole, you look up dead peasants insurance, and it still is an idea that basically Walmart does this a lot, I think, where they take out insurance on all their people, right? And Walmart has the largest employment force in the world, I think, at least for a private company. And so they have insurance, or I don't know if they're still doing this, but they had insurance on every one of their employees. And, when you have that many people, there's continually people, just dying because that's just how life goes. And so that was an additional revenue stream for themselves.
Oh my gosh, it is. It's crazy. I'm looking at the article. It's crazy.
Yeah. So there are strategies to do that. There's if you get into the weeds of insurance, there's like private placement, life insurance, and all kinds of advanced kind of things you can do as far as putting businesses inside of a life insurance policy. But that's well well away from the stuff we usually see. So the answer I'm giving here is just in terms of if you have life insurance on yourself, right? So that is the typical answer. But like it says on the screen there, it depends. And you can get into all the nitty gritty there if you want to. But just recognize that if you do take a tax deduction, it creates a tax event on the other side, and that may not be what you want. So
Right.
that's
So a cause and effect.
There is cause and effect, yes.
Okay. So another question, Neil, is what are the tax implications of receiving inheritance or gift?
So this is very much one where it depends. So there's two different cases.
Right.
Well, let's say three different cases. So there's an inheritance where somebody has passed away. Then by and large, you get what's called a step up in basis. So, and keep in mind, the person receiving a gift in 99.99% of cases doesn't pay anything, but the person sending the gift might. So if you receive an inheritance, that's going to be tax free to you. The estate that you're inheriting from may have to pay an estate tax, and this is one of those things where Trump doubled the estate exclusion, and at the end of 2025, that's going back to half of what it is now, because all of the well, not all, but a lot of the Tax Cut and Jobs Act things are expiring in 2025, which we're getting close to. So right now, if you have an estate that's under about $22 million, then you are exempt from the estate tax. But once you get over that, then the estate tax comes into play. And different states have different rules. So like New Jersey has, I think it's 10 million on their estate tax, and most states follow the feds, but some have their own individual rules. So that's something else to watch out for. But if you're inheriting, then that's going to be tax free to you. Even if the estate has to pay tax, that's on the estate. By the time it gets to you, you're free and clear. So this is actually the mechanism by which middle class wealth is transferred. So you have grandma, she has a house, she paid $3,000 for it in 1950. Now it's worth $400,000. She passes away, leaves it to her kids, and now they have this asset, 400 grand, that they didn't have before. And whether somebody lives in it or sells it or whatever, that's to be determined after that point. But on the day you receive it, it's as though you bought it for whatever the value is that day. And um, and so if you hold on to it for another year and then sell it, maybe there's a gain between that year long holding period, but you don't have to go back to when grandma bought it. Your basis is on the date of inheritance, and that applies to all property, and that's the step up in basis. So it's like I said, that's the middle class wealth transfer method. That plus insurance, life insurance. So they're actually, when Biden got elected, they were talking about eliminating. Oh, we just lost Serena. They were talking about eliminating the step up in basis rule, and the uh, if that were to happen, that would be a huge blow to the middle class. The people who are super wealthy, where the family home is not that big of an asset, or not as a percentage of their total wealth, not going to be impacted that much. So fortunately, they did not get anywhere with that particular proposal, but it is waiting in the wings there to be on the lookout for in the future. So that's one side of it. That's inheritance. If it's a gift, so anybody can give anybody. I think the number this year is 16.5. It might be 17,000. I'd have to look it up. Somewhere around there. It gets adjusted a little bit each year. So, I can give any single person 16 grand, and that's totally tax free. And I don't have to report anything. It's just freebies. So, like, let's say I've got my sister and my brother-in-law. Let's say I wanted to give them $30,000. I could give my sister 15. I could give her husband 15, and then everybody's tax free. If we wanted to give them $60,000, I could give my sister 15,000. I could give her husband 15,000. My wife could give my sister 15,000, and my wife could give my brother-in-law 15,000. And then all tax free, no reporting or anything. If the numbers go above that limit, and again, each year changes a little bit. If you go above that limit, then it's still tax free, but it does start to count against your lifetime exclusion. And that's the one we talked about just a minute ago with the 22 million. So you got to file a gift tax report, and that 22 million is for you, basically a married joint couple's lifetime. So if you give it away before you die, then that uses it up, and whatever's left over becomes taxable under the estate tax. So a lot of people try to limit their giving to that exclusion threshold. So that's another case of things going on. And then the third case that we see sometimes is we had a client with this last year, where he's got an elderly parent, and the elderly parent gave him stock, and he didn't sell the stock and then give the money. He just gave him the stock. And so then it gets into, well, is the stock in a gain position or a loss position compared to the original purchase by the parent? And basically, the it's more complicated than this, but the short version is that the gift receiver receives the basis that the giver had originally. So if this stock was bought in 1978 and it was $3 and now it's $100, well, now if the recipient sells that stock, then their basis is $3 and they have a $97 gain, even though it might have only been $100. So it might have even lost money from the time they actually received the gift, but because of the way it works with property like this, when everybody's still alive, then there can be tax implications. So again, it depends on the exact situation and what's going on, but that can get complicated pretty quickly. The easiest, simplest thing to do is divvy things up under the exclusion amounts, and or when you have inheritances, those kind of take care of themselves. But if you're trying to give away lots of money before you pass away, then you get into these tricky situations where you're passing basis along to your recipients as well. So,
Oh, wow.
so yeah, be careful with that, and consult people before you do it if they're talking about large amounts.
Oh, wow. So you said 16,500, you think, or it could be
I
17K?
I think that's the number. Let me see if I can find it real quick. Well, let's look at 2024 now. 2024 gift giving exclusion limit. A little quick live Googling. I know that's not showing up on screen. Let's see. IRS announces increased. Oh, for 2024, it's 18,000. Okay.
Oh, wow. Perfect.
So, yeah. So that's up for 2024. So going forward, 18 grand is the number you want to keep. If you can keep your giving under that per person and spread it out however you need to spread it out, then you can move a good bit of money that way. And if you're above that, then you're a rich person and you should talk to somebody professionally.
So
So
18K, guys.
yeah, that's the thing. And apparently the lifetime gift exclusion for this year is 13.6 million. So for a married couple, that's going to be 26 or 27.2 million jointly. So yeah, that's those are the numbers for 2024. And like I said,
Yeah.
they change every year. You got to keep up to date with it.
All right. So, Neil, I have another question, which is about estimated tax payments.
Ooh.
Someone wants to know who needs to make them? Like, what are they for?
So what are they for? So I'll try to answer this in 5 minutes or less. So estimated tax payments are for people who don't have sufficient withholding, and that can be in various forms. So it could be we've seen this a lot with tech employees who get stock. Um, we had a number of IPOs back in 2020 that people got slammed on. So if when you earn money, you owe tax on it, right? And the IRS has decided, or Congress has decided, enforced by the IRS, et cetera, that you have to submit payment, on a quarterly basis. Now, if you have withholding on that income, that withholding is being done on your behalf already. If it is enough to cover your tax bill for the year, then you don't have to do anything else because that part is already done for you by whoever's withholding, usually your employer. If it's not enough, even if you have an employer, or if you're a solo business person or an independent contractor or something along those lines, then you owe estimated tax payments each quarter. And there's kind of two basic methods to do it. And one is you file based on last year's numbers, and you file at least, basically 10% more. Then you're in the clear as far as penalties go, because they say, okay, that's your safe harbor. You've made a good faith effort, even if this year's numbers are different than last year, which they always are. As long as you cover your bases from the previous year, you're good, and will settle up in the springtime of the following year. The other method is where you actually calculate whatever you're earning each quarter and annualize that out for the year. So in quarter one, you have 3 months of history, and those are due April 15th. And so you take that 3 months, multiply by four, say, I think my income's going to be this, and I'm going to pay you 1/4 of the tax based on that. And then quarter two comes around. Those are due June 15th. And so you have 5 months of history there. So it's like, okay, well, I take those 5 months, I run them out to 12 months, and I estimate my income for the year. And then based on that, I'm going to take a prorated amount and pay that less the amount I've already paid in Q1. And then Q3 rolls around, those are due September 15th. You have 8 months of history at that point, and you do the same calculation. You figure out whatever the annualized amount is, and then you back out however much you've already paid for Q1 and Q2. Q4 is due in, well, for most filers, Q4 is due January 15th of the following year. So like today is actually the estimate uh, the estimate date for Q4 of 2023, because the 15th was MLK Day, so they were closed. And um, and so that you have the full year history, and now you should have a pretty good idea of what your tax liability is going to be. You calculate that, subtract out the amounts you've already paid for Q1, 2, and 3, and you pay the balance for Q4. If you're a corporate filer, like a 1120 C corporation, then that fourth quarter estimate is actually due on December 15th and not January 15th. So that's a little thing that trips people up sometimes. So that's what it is, basically. They just want you to pay ahead of time so that you don't have. I don't know how deep I want to go into this, but during World War II, so the income tax was created in with the 16th Amendment to the Constitution, and that was in 1913, 1910s, 19 teens, somewhere there. I think it was 13, but uh, that was when the income tax was created. And the pitch at the time was that this is only going to affect rich people. If you're just a regular person, you don't have to worry about it, right? And over time, that ended up not being true. So, but when it started, everything was just the annual filing, and so you went through the whole year and you had whatever tax bill, and then you paid it, hopefully, right? And then come along into World War II, we had the Current Withholding Act, and this was well, I'm not going to get into the whole thing with Milton Friedman, but basically they expanded the tax base. People weren't paying because people are not that great with managing their money, and they didn't want to. So they passed the Current Withholding Act, which basically said you had to pay as you go. You can't just wait till the end and pay it all. And so we've been with that system ever since, because they had to pay for the war in World War II. And um, and so that's where the whole thing comes from. So if you don't make those payments, those estimated payments quarterly, then you get a penalty, an underpayment penalty. And this typically works out to be somewhere around the range of 3% of the tax. And it depends on the exact numbers involved, but yeah, so you will get an extra charge on your taxes if you don't put in those quarterly payments. Now, I have seen people who have made a business decision, say, well, I can either pay the government this money, or I can hold on to it, make better use of it, and then pay the extra fee on the end. And that's a choice that can be made. I can tell you, technically, they don't like that. So, but basically, you just get charged more. So basically, anybody who has a tax liability that is not covered by their income withholding is supposed to file quarterly estimates. And you can do that online. You can do it by mail. For the feds, it's 1040 ES is the name of the form, and you just send in a check, or you can pay it on EFTPS online. And every state has their own system, so it's more work. Now, I will tell you that it's a good practice just in general to sit down on this quarterly basis anyways and figure out what's going on. So one of the things that we do with our clients is we implement the Gusta plan, where we have management meetings, and part of those management meetings are to review your books. So this is something that you should be doing whether you're making an estimated payment or not. You want to be reviewing your books on a month-over-month basis, a quarter-over-quarter basis, and a year-to-date over year-to-date basis. And then you want to see what's going on in your business figuring out what is working, what's going right, what's going wrong, how have you executed on your plans that you had from last month, last quarter, last year, and are things going in the right direction, the wrong direction? Do you need to adjust? And that's a whole other thing. Um, so you should know your numbers, whether you need to make estimated payments or not. And again, there's whether you want to or not, and then there's the two methods. Last year's versus this year. So that's kind of the short version of estimated payments. And with that, we are down to just a couple minutes. So we're going to cut off the questions here. And anybody who's watching, next steps people wonder about. So we have a free LinkedIn group you can join. Just go to taxsherpa.com/group. I'll be posting recordings there and templates and all kinds of stuff. I will tell you that we are launching a new product in the next, let's call it 3 weeks. And all the people in that group are going to get it for free, and everybody else is going to have to pay for it. So just be aware of that. And then, to catch these sessions every Tuesday, 6 p.m. Eastern, go to taxsherpa.com/live. That will take you to the next one. So like if you go there now, it'll take you to this session. And then tomorrow morning, I'll update that link and it'll go to the next scheduled session. So those are the next steps if you wanna keep up to date with us. And then best thing to do is really just join the LinkedIn group there, because you'll get all the freebies. And that's kind of where we are for the week. So again, this was the first session back from the holiday break. We have Serena and Ram here. And any closing words you guys have? I know Ram's been silent this whole time.
Yeah, Rams, anything from you?
I don't know, he's still muted, so I don't think he's actually present. Oh no, he's going unmuted.
I'm good. Yeah.
Drum roll, please.
Yeah. But Serena, any closing thoughts that you had?
Don't forget, it's 18K for any gift
Yeah.
per person. I mean, I'm amazed by that. I didn't know they went up to 18K.
Yeah.
So
Yeah.
that is my closing statement.
I remember it's just individual person to individual person. So like my sister, she's got 2 kids. We could do, a round of 4 for me and a round of 4 for my wife, and we could transfer a good chunk of change that way. So that would be what, 144,000? Is that right?
Pretty good. Yeah. Super
Yeah.
good.
So don't think you have to go over the exclusion when there's other options.
Yes.
But if you have to move 500,000, then you're gonna eat into your exclusion, and that's just how it is.
Yep.
Alrighty, so that's it for this week. I will post the recording here in the LinkedIn group once I get it all cleaned up and edited. And otherwise, we'll see you guys next week.
Yep. Happy 2024.
Happy 2024.
Yeah.